Long-term care insurance. It's a huge piece of the retirement puzzle, right? But oh my gosh, the tax rules can be a real headache. So we're going to cut through all that confusion and answer the two biggest tax questions we hear all the time.
All right, first up, the big one everyone asks about the cost. Can you actually get a tax break for the premiums you're paying? In other words, are they tax deductible?
And the short answer is pretty good. It's yes, sometimes. But you know that sometimes is doing a lot of work there. It comes with some really important strings attached. So let's break down exactly what you need to do to qualify.
Okay, so let's dive into our first section, exactly how you can go about deducting your long-term care premiums.
So to get this deduction, you've got to clear two main hurdles. First, you have to itemize your deductions on your tax return. And honestly, with the standard deduction being so high these days, fewer people are doing that. Second, and this is a big one, your policy has to be a tax-qualified plan. That just means it meets specific federal rules. And here's the next number you really got to wrap your head around, 7.5%. See, the IRS counts your qualified LTC premiums as a medical expense, but, and this is a big but, you can only deduct the part of your total medical costs that goes above 7.5% of your adjusted gross income, your AGI. Let's be real, that's a pretty high bar for a lot of folks to clear.
But if you do manage to clear that bar, this is where things get really interesting. The IRS actually sets a limit on how much of your premium you can deduct, and it's all based on how old you are. I mean, just look at this table. If you're 40, the max is about $480. But if you're over 70, wow, that jumps to over $6,000. It's pretty clear the government gets that the need and the cost for this kind of care really goes up as we age.
So, who actually ends up benefiting from this, really? Well, it's usually going to be higher income retirees, self-employed people, or business owners, folks who are already itemizing and probably have higher medical bills anyway. On the flip side, if you're someone who just takes the standard deduction every year, you're probably not going to see a tax break for these premiums. Okay, so that's the whole story on deducting what you pay in. But what about the other side of the coin? What happens when the policy actually starts paying you? What about the money you get from the policy? And that brings us right into our second section. Are the benefits you get from your long-term care insurance policy considered taxable income? This is a big one. And thankfully, the answer here is overwhelmingly positive. Generally, no, the benefits you receive are not taxable. This is a massive advantage. But as you can probably guess by now, there are some rules we need to pay attention to. For those benefits to be tax-free, they have to be used for what they call qualified long-term care services. So what does that mean? It means things like help with daily activities, bathing, dressing, eating, or the kind of supervision someone might need because of a cognitive impairment like dementia. Now, how the policy pays you out actually matters a lot. There are two main ways this works. First is the reimbursement model. This is super straightforward. You have a qualified expense, you submit the bill, and the policy pays you back for it. Those benefits? Not taxable. Simple. Then you have the indemnity or cash model. This one pays you a set amount every day, let's say $200 a day, whether you spend all of it or not. This is also tax-free, but there's one big catch. And that catch comes down to this number, $420 a day. That's the IRS limit. They call it the per diem limit for 2025. If your cash plan pays you more than that per day, anything over that amount is considered taxable income. So while the flexibility of a cash plan is awesome, you absolutely have to keep this ceiling in mind. Okay, but traditional long-term care insurance isn't the only game in town anymore. So for our third section, let's just touch on some of the other solutions that are out there today.
A lot of people are looking at what we call hybrid products now. For instance, there's hybrid life/LTC insurance. It's exactly what it sounds like. It combines a life insurance death benefit with long-term care coverage. The cool part is, if you never end up needing care, your family still gets the death benefit. Annuities with LTC riders are another really popular choice. They give you a stream of income, but they can also unlock a much bigger, tax-free pot of money specifically for care if you need it. These things offer a lot of flexibility, and they help people get past that use-it-or-lose-it feeling they sometimes have with traditional policies.
All right, we've covered a ton of ground on what you pay in and what you get out. So let's wrap this all up and talk about what your next step should be. This quote really hits the nail on the head. While getting a tax deduction is nice, it's not the main event here. The real savings, the real value, comes from protecting yourself from massive out-of-pocket care costs. At the end of the day, long-term care coverage is about protecting your retirement, your family, and your entire financial plan. Look, navigating all these tax-qualified plans, hybrid options, and different payment models, it can get complicated fast. At the Annuity Expert, we help people sort through all these options to find what actually makes sense for their financial picture. And it's really important for you to know, our services and consultations are always completely free.
The most important thing you can do is be proactive about this. Please don't wait until you or a loved one needs care to start making a plan. We'd love for you to contact us for a free consultation to talk about your specific situation. You can give us a call at 770-755-1565 or just visit our website to learn more. Honestly, making an informed decision today is the absolute best thing you can do to protect your future.